of the week in charts. Obviously, I want to thank all you guys and girls for attending. I appreciate you people that are on YouTube too tonight. We do this normally through GoToWebinar, but we're going to try to do a little simulcast tonight. See how that goes. So what we talk about? Well, obviously, current market conditions. I have a lot to say about that. Your questions on trading, hold off with your stock picks till we get to the live charts. That way I'll know which ones I covered and which ones I did. And also we'll cover crypto quickly before stocks. And so I just have a few slides to go through and we'll get to all that. Oops, that's old slides. So today we're going to talk about a little bit of performance-based metrics. I have some questions about the TFM 10% system specifically, and there's a few other things obviously you want to cover. And then if you have any questions, feel free to type them in now, and then we'll hold off again on your picks until we get to the live charts. So if you want to attend this live, you can go to davelandry.com/webinar. YouTube is at Dave Landry, and then TikTok is at Trend Following Moron, and Twitter is at T Following Moron. I guess Twitter is now X, as you know. There's the disclaimer screen. As you know, you can lose money trading. As often sum it up, all predictions are about the future, and lots of stuff can happen between now and then. I borrowed that from my buddy Greg Morris. All right, let's do a quick update on the TFM 10% system, and there's some follow-up questions I want to cover. So the TFM system uses a 50-week simple moving average, and this is on a weekly chart. So you can see right here is weekly charts. And then I put in these zones recently, and I'll explain those in just one second. And it's also based on a 50-week closing high. So everything pivots, so to speak, off of that. And you can see the parameters over here. So the original indicator was 90% of the 50-week closing high. And and then these new indicators were added in because Jeff, who's here tonight, was saying that, you know, once you get below 5% from that 50-week closing high, things can get a little dicey. And he's right on that. You will get a lot of whipsaw, though, and I'll flesh that out in just one second. But as a general statement, as long as you're within 5% of the 50-week closing high, the market is in good shape. And in general, I learned this from Greg Morris, a market doesn't make new highs, at least all-time highs, and then implode. It usually you have some time to get out of the way. You don't have unlimited time, as I often preach, but you do have time. And what Jeff was pointing out is that once you get into that 5% zone, then it's a bit of a caution area. And then 10%, and that's where the system was based on, but I used 10% because I felt like if a market was going to lose half its value, which it can do fairly often, believe it or not, 2000, 2007, pandemic was 30% loss, and you can go way back in time, and I'll show you the spreadsheet. I know you want to part with me in a minute with some of these horrible bear markets over the years. But if the market's going to lose 50% of its value, it's going to lose 10% first. So I was thinking, why not get out when it loses 10%? And as a whipsaw filter, it also has to close below the 50-week moving average. Now, keep in mind, this is the weekly system, so you might want to look at some daily stuff too, like we talked about bow ties in the previous Dave Landry's the Week in Charge and Landry Light, and I'll bring up some of those concepts as they come up tonight. But you also want to look at daily slides, obviously. Now, again, the green zone means that you're less than 5% away from the 50-week closing high, which we set just this last summer. By the way, to sell in May and go away crowd, they just they got creamed this year because we had the best rally of the year over the summer. So don't believe everything you hear, and that adage doesn't actually work. It's more of a June thing, and Tom McClellan has done a lot of work on that. Anyway, once you drop into this pink zone, you are more than 5% away from the 50-week closing high. And as Jeff pointed out, and I confirmed, a lot of times when you drop into that 5% zone, that caution zone, 5% or more away from the 50-week closing high, bad things tend to happen. And with any momentum-based indicator, a moving average or Landry Light on a moving average or bow tie proper order within moving averages, or put in your favorite momentum indicator, when that indicator starts indicating downside momentum, a lot of times that indicates even more downside momentum. So sometimes a slide begets even more of a slide. And again, 10% would be the red zone that you see on the bottom. Now, the sell signals are less stringent than the buys. And I've been over this 1,000 times, but let me just go over it quickly. I'm getting a lot of Twitter questions on this, or X questions. That sounds, it's kind of hard to say. But if you have a weekly close 10% or more away from the 50-week closing high, and the close is less than the 50-week simple moving average. Now, everything I did with this, by the way, on a side note, was based on a calendar chart. So Friday to Friday would be your week. But I've noticed a couple of questions on some discrepancies in Twitter or X because they may have been looking at a rolling chart. And maybe some of my research, I don't remember exactly when I did what, but I'm sure I didn't just research this on a Friday, okay? But the signals for now, we're using a weekly close below the 50 simple moving average and a weekly close 10% or more away from the 50-week moving average. Now, I'm sorry, from the 50-week closing high. So again, a calendar means every Friday you're in the week, and then you start a new week on the Monday. So it'd be 5 days of the week. At a rolling basis would be like Thursday to Thursday, Wednesday to Wednesday. And I'm sure a lot of the testing that I did, like I said, was during the middle of the week, even though it was a calendar week chart. Now, I haven't really thought it through yet because obviously the market could do something bad in the middle of the week after closing 10% below the 50-week closing high, okay? So I haven't really thought it through completely. The only thing that kind of scares me is, well, one, you might get a little whipsaw by getting out a little earlier in the week. But on the positive side, if the market would have crashed like on a Friday or a Thursday, and let's say you got a signal on a Wednesday, then that might keep you out of trouble. So in trading, there's always a trade-off. I wouldn't pick things apart too much. But yes, if we do get a signal intra-week, I would point that out. Luckily, this last signal here, which we'll take a look at right now, there it is, was on a Friday. Let me just end it at that. So it turned out to be a calendar weekly sell signal. And I wouldn't get too caught up in it. Okay, the question is, use SPX, ES, or SPY. If what is going to pick nits, that could affect it too. Yeah, the spiders have a slightly different performance characteristic, but longer term, it's negligible. It's not that big of a deal. And I'm still long, believe it or not, and it's been hard because I've been up over 50 points at one point, even though it's only 100 shares. But shit, 50 points on 100 shares is $5,000, and that's nothing to sneeze at. And I really don't want to ride it all the way back down. If we have time towards the end, I'll pull up the Qs in the ACP platform, so it'll look just like this. But the Qs are actually looking better than the spiders and then the S&P. But yeah, for this system, because 10% is really not that far away, okay, you definitely want to use something like the S&P 500 or the Qs, because if you try this on something with a very high HV, that stock might move 20% or more in one day, whereas the market 10% in general is a good round number. It probably could be a little bit bigger for the NASDAQ. I haven't done that research, but I did like the way the Qs were performing. And for S&Gs, I took the Q trade a while back, and I bought 100 shares at $319.49, if memory serves. So right around $319.50. Now, I got asked a question after I published a sell signal again on X, and then the market rallies a little bit and gets back above the 50 simple and gets within 10% of the 50-week closing high. Somebody said, well, is that a buy? And the answer is no. It's no longer a sell signal, but it's not a buy signal. The buy signals are a little bit more stringent. When I first got started in trading and I was doing a lot of mechanical systems, I thought that, okay, you get a sell signal, but then the next day it's no longer an active sell signal. Let's say you were to enter on the day you have the sell signal, and in this case, it's a market on close type of system. So you want to get in right around the close, kind of like the buy and B pattern with the IPOs. But anyway, when I first again got started programming all these systems, I'm like, well, what would happen if you just, let's say you got in something and it didn't work out, and then you no longer had a sell signal the following day, just get out. Well, the problem is you would end up chasing your own tail more than likely. So if this market comes roaring back, then yeah, that would have worked. You got out for one day, and then you got back in the next day, and it goes straight back up. But that doesn't always happen. So I wouldn't get too excited about this rally just yet. I'm glad it's happening. It's much easier to make money on the long side than the short side, but I'm not afraid to short. In fact, we've got a short recommended for tomorrow. So yeah, Jack, whatever you want to use in this, but do your own due diligence. And I'm kind of shocked at how well this system has been received, and a lot of people have been really happy with it, and it's I'm pretty proud of it. And the other thing it's done, and this is kind of a knock on wood thing, come in, is that it's gotten you out of every bear market. And I can't guarantee this. I wish I could, but it's gotten you historically over the last 100 and something years, or 100 years, it's gotten you out of every bear market before things kind of got ugly. And I'm going to show you some of those quote unquote diaper change moments in a minute. And obviously the depression, there was a 90% drop after the exit. So these things can happen. We'd have a lot more problems, I guess, in the US if we lost 90% of the value, but 50% haircuts in the market are not that uncommon. In fact, I don't know who said it first. If somebody knows, please let me know, because I'd love to give them credit. But one of my mantras is every asset class at some point in time will lose 50% or more of its value. And there's these guys on my way to the gym. I put the radio on. There's these guys trying to get you to buy gold, and it's like, if you're like me, I can't lose 30% of my money. It's like, well, you could lose at least 50% of your money buying gold. If you don't believe me, go and look at the charts. And I did some research a while back where you could have like a 20-year period in gold, or any other market for that matter, where you're actually underwater. So be very careful if you invest in something. Now, I am an investor because I'll stick with a stock as long as it moves in my favor via a trailing stop. And we've held stocks sometimes. When I say we, I'm talking about the direct recommendations of the service, being me and my clients, for upwards of 2 years. So even though I'm slotted as a swing trade, I will stick around longer term. Now here's the spreadsheet with the diaper changes in it, and then if you go way back to the depression, again, it's like an 80 or 90% drop. This is how far, and I borrowed this term from Ian McActivey. He's no longer with us, but he was an awesome guy. And he would talk a lot about global economics and things like that. He used a diaper change moment as an example, and that's when the market just absolutely implodes and everybody freaks out. And you can see these numbers are fairly big. So if you'd have gotten out of the market in 2000 and what was this, 2008, you would have saved 52% after. So it dropped 52% more after you got out. And then obviously in 2000, another bear market, 44%. Pandemic, as I just mentioned, was 28%, nearly 30%. Now, the pandemic was a whipsaw type of filter. I'm sorry, it was a whipsaw type of situation where the market came roaring back. But I can assure you they won't always do that. And as I preach, market timing is less about beating the market and more about not letting the market beat you. Now, there's other ways to get back into a market instead of waiting for this longer term signal. And then maybe you'll see some transitional setups in individual stocks and some things like that happening. And maybe you want to take a daily signal if you have some longer term trend following that you're doing. But be prepared to be whipsawed every now and then. Now, if the market is erratic and goes all over the place for several years, but it ends up here somewhere from down here, then buy and hold will win. Buy and hold won through the pandemic, okay? But it sure was nice to sleep at night while that market dropped that extra 30%. And as I've said 1,000 times, I had a buddy of mine that was visiting right around then or whatever, passing through town. He's got family here, and he moved away years ago. And every now and then he stops by to visit when he's seen his family. And he literally was not sleeping at night. Anyway, one thing kind of fun about becoming active on X is I'm getting a lot of feedback. And so this gentleman said that since 1982, 60% sell signals were followed by a drop of 10% or more. Okay. And I went in and confirmed his analysis. And if you look at the spreadsheet with the diaper change, and if anybody wants a spreadsheet, I'll give it to you too. But you can see, like, so his point is that, okay, the market, you get a signal, here's 28%, so it dropped at least 10% more after the sell signal. You can only see like only one case where it didn't move positively in your favor after you got out, or the market didn't continue to drop, so to speak. So again, as I said a second ago, market timing, less about beating the market, more about not letting the market beat you. Buy and hold will win quite often, but not all the time. And a 50% more haircuts is not that uncommon. And you don't want to lose half your money going into retirement. Now, I'm not a registered investment advisor, so I can't tell you to time the market, but I would suggest you study what I've put out there for free. And I do have a free market timing course. And I don't have an URL for you right now, but I think if you go to, I don't have it, but I'll put it in the comments below after the webinar or tomorrow. But anyway, I would suggest that you learn about market timing and learn about how longer term the market doesn't always go up. If you have the layman's guide to trading stocks, I would read the first 10 pages. The people that are coming out of the woodwork to talk to me about what to do with their stuff, friends and family, I'm forcing them to read the first 10 pages. And a lot of what I just said is all in there, like the market does not go up longer term. It might take 25 years or more for a market to make new highs, and people have a hard time believing that. And I think that the way these buy and hold people who sell you on buy and hold, I think the way they make a living is that a lot of times it does work, and it might work for that 25-year period that they have a career, or whatever that period may be. So let's say they came in 2003 and they were preaching buy and hold. Well, that would have been a great thing because that was the bottom of the last really, really major bear market. But buy and hold will work until it don't. Okay, so just real quick, I want to briefly talk a little bit about surviving and prospering during bad times. And one of the things I was preaching a while back when I did one of these weekend charts, and you can find me on YouTube, by the way, at Dave Landry. And in doing that, or if you do that, you go in and go back a few weeks, and I did a webinar on surviving and prospering during a bear market. And one thing I said was see each position to its fruition. What you have to realize is, as trend followers, well, first of all, great trends don't come along every day. You do have to wait quite a bit. But the thing is, the real money is going to be in the occasional outlier. And as long as you have good stock picking going in, you will eventually catch a few of those outliers. And I've been criticized for making them sound too elusive, but it is a little elusive, and you never know when that big outlier is going to come along. And you're much better off just sticking to your original plan. Don't throw caution to the wind. Have a stop in place or a stop in mind on where you're going to get out. I got stopped out of a short today. For instance, it happens, spelled with a silent SH. Well, I've already demonetized, so shit happens. But anyway, you want to see each position to its fruition. That's one of the things that I said earlier in an earlier webinar. And also, remember, with market timing, you have time, but you don't have unlimited time. And again, I can't give direct financial advice, but anytime that market drops 10% or more, especially if it closes below a 50-week moving average, you really need to think long and hard about getting out. 1987, that happened on a Friday. We all know what happened on a Monday. So you can't just say, oh, I got a signal, but let's see what happens tomorrow and the next day and next day. If you're following some type of system and it tells you to get out, you have to take that signal. Greg Morris, again, you always, once you start quoting him, you can't stop because you get so much good stuff out of him. But he once said, we take all signals as if they will be the big one. So with his market timing, if they have a sell signal, they're like, okay, we could possibly have a 50 or 60% haircut in the market. This market could go down for years. So we have to get out. And then every now and then you get whipsawed. And again, when you have a market, let's just take a look at 1 year. So if you have a market that does this for a year, especially if it has 20 and 30% spills in between, but somehow ends up higher, that buy and hold person is going to look like a genius. Okay, so Hal said, things look so ugly going into this week. I'm tempted to cut all my core positions. And I like what Lauren said, tempting indeed, but good trading / invested very rarely follows our human instincts. Same as George, I will hold with hard stops. I have lightened up our open short and strength though. And like I said, I hear you. And the thing is, you never know what might continue to work. So if you take a look at the portfolio from when Hal posted, you can see where we're up about 6K. And then I just took a snapshot in the middle of the day, and it's going to actually look a little bit better than this. And we were up to 62.26. Now, if you just look at the longs only based on the snapshot, there was $1,000 difference. So let's say you're concerned about the market and you definitely want to get out of those longs. Well, it turns out the shorts, or the one short that was left, actually end up biting us in the butt. So it's just the opposite of what you think. But the longs so far, knock on wood, are doing pretty good, as you can see. So that's why we don't bail out. And I can't, this was one of the better ones as far as signals are concerned. Thank you, Jeff. Jeff's posted a link, and let me see if I could. I don't know if I can cut that and copy it over to. No, I can't. I can't do it on the fly. But for you people over in YouTube, it's davelandry.com, which is my website, obviously, /courses /market-timing-mini-course. So davelandry.com /courses /market-timing-mini-course. And that'll get you there. There'll be a registration link on that page, and you'll get a login within about 2 or 3 minutes. All right, let's shift gears real quick, and I just want to show you a crypto trade from last week. Truth be told, I really haven't been paying enough attention to crypto lately. I'm just getting pulled in all these different directions. But I was reminded last week that I need to start paying attention again. So this is Sushi. You know what these guys do? I have no idea. I guess it's some kind of swap or something that they swap things with. I think it's called Sushi Swap. But anyway, I don't care what they do. So as I often say, and I'll show you this in just 1 second in TradingView, and you can do it in stock charts. TradingView just has a few more symbols, but which is not as important as it used to be, because KuCoin, you can't use KuCoin with the US anymore. It creates no way to verify your account. So that's kind of a bummer, because KuCoin had all kind of crazy coins. So it's probably not as important with now as it used to be with all these little shit coins. But anyway, this one is available on a lot of platforms, Sushi. And as I'll show you in a minute, sometimes you could just buy the strongest ones and be willing to stop out if you're wrong. But there's been times when I could just buy one after another, get stopped out on a couple, but then 3 or 4 of these hit. And like I said, it was a couple Thanksgivings ago, I had like 6 of them hit the profit target in one day. And it was just one of my best days of the life. It was nice and cool outside for a change in Louisiana. We were frying turkeys, drinking beer, and trading crypto. So it didn't get much better than that. But anyway, there's my trade down there. Now keep in mind with the crypto, I'm doing nickel and dime stuff. I'm not going crazy. And I wouldn't recommend anybody goes crazy in crypto. And kind of my pipe dream here maybe is that I could parlay a small account to a very large account. And I think when crypto is blowing and going, I think us older guys who've been around a little while in the trading and younger guys who are disciplined can really have an unfair advantage, because we know the money management, we know relative strength, versus other pairs and things like that. And I'll show you the relative strength in just 1 second. But anyway, so technically I probably should have gotten in much, much earlier. But when I just got around to doing my crypto scans, I saw this thing was really blasting higher. So I just jumped in at the market. And then what I do with crypto, just to keep it easy because they're so darn volatile, is I just use a 20% initial profit target, or IPT. So I just take my entry and multiply it times 1.2, and I put it in a limit order at that level. And I see there's a little commissions in here, but you can see that I got in around 88 cents. And if you multiply that by 1.2, that's 106. And once you hit the IPT, you bring that stop up to break even on the remainder. And that way, barring overnight gaps, you have the potential for a home run. And then in this particular case, based on this big rally here, I brought it up to $1. And that way, at least I'll make something on the trade should it stop out, or I should say when it stops out. And so if you add these up, starting with 1,000 and then round number 600 and then 565, that's about a 16% overall return in one day, which is much better than a poke in the eye. If you could bang out a few of these a day, you'll be doing really good. I know you shouldn't get into permanent income hypothesis and annualizing, but let's say you could make $100 a day when the relative strength is really blowing and going. It has to be a really great market for this to happen. But $100 is $25K a year. Now, of course, it cuts both ways. You lose $100 a day, then you're down substantially. All right, so let's shift gears and let's go over to TradingView, take a look at some crypto stuff. And then if there's any pairs you guys want to look at real quick, and then we'll hop out to the live charts and stocks in just a few minutes. So let's get this over here and keep the questions flowing. Okay, so here's crypto. And let's see, where's my watch list? Let's see, here we go. So all I did for this sushi trade was I came in here and I sorted by percent change. And I started going through these. Now, something like that's kind of thin. It's up 50% today, but it looks like it's kind of thin just by looking at the way it acts. This one's already kind of shot higher and come back in. So did that one. So just keep going through these. And if you find some that look kind of interesting, they're just beginning to break out a little, it might be worth a shot, especially when the overall market is doing really well. Now, in this case, I'm not seeing a tremendous amount that are doing fantastic, but they're looking okay. Like this one, I don't know how liquid it is, but this is something that would catch my eye because it's banging out new highs. Now, ideally, you want to, longer term, you want to trade something like Landry Light pullbacks, but every now and then when the crypto begins to take off, again, you can just come in here and then look at the strongest pairs and look the position there. So the first one was MPL. Let's just make a note of that one. So let's say it's at 7 round numbers. Oh, that's coming back in a little bit. Now, usually I don't buy into new highs like this. Usually I trade pullbacks, as you probably know. But again, when these things are really going crazy, and right now they're not going exactly crazy. They've already settled down a little bit. Things change really quick in crypto. But you can go in and just play the RS game. And by RS, I'm not talking about any indicator other than the percent change. And you want to look to be in the strongest ones with a few caveats, like it has to be thick enough and maybe a little structure behind it and possibly banging out some new highs. And then you can look for things like overhead supply. Now, Bitcoin is stalling out a little bit tonight, but it's had a pretty good run. I don't like this drift in here. I prefer if it accelerated higher and then had a very orderly pullback. But it is kind of interesting. If it does accelerate higher from this, I'd feel a lot better. But right now, it's kind of has this drifting wedge look to it. And that's actually kind of a bearish thing when the market kind of drifts higher. So we'll just have to wait and see how it shakes out. But I think that so far it looks pretty darn good. And we've got a lot of clear air here for a while to deal with, no overhead supply for a while. So that's certainly a good thing. All right, any questions on crypto, any individual pairs you want me to look at? And I'll go ahead and get ready to shift gears to go to stocks. Okay, let's start with the P's. We had a bang up day today, obviously. And if you take a look at the P's, you can see that the tops have been falling for quite some time in here. And I don't adhere directly to trend lines like connecting the dots over the tops. I kind of like to draw them through the bars. And mathematically, that would be equivalent to linear regression. So here you can see I kind of have the pickup sticks drawn on a chart. And the thing about drawing the trend line through the bars is if you have nice persistency like we had back here, okay, let's see if we can back the chart out. No, it doesn't work like I thought it would. It used to be when you back the chart out, these linear reg lines would move with the chart. Maybe there's a way to do that. Trading poker. Didn't realize it was live tonight. Well, we've been trying to get it live for weeks. So, but yeah, I'll try to. I'm going to try to make them live on YouTube too, so everybody can participate. Anyway, so I like to draw trend lines like this, and that way you can see how persistent a market has been. And every now and then it's kind of fun. I know you want part of me, but it's kind of fun to put these linear reg lines in here and see what happens with those. But I don't actually use these in my analysis. I just kind of like to show them as just one way that you can kind of gauge a market. And of course, the first thing I always do above and beyond everything is I just look at the market. Where was it and where is it now? I look at the net price movement. And by accident, I just plotted the 50 and the 200. So we're back above the 200-day moving average, still below the 50. And we still have a lot of Landry Light below that 50 simple moving average. That's just the highs or less than the moving average. If you look at the last week of charts, I talked about that quite a bit. NASDAQ composite, decent day there too. Tops are still falling, as you can see, but it had a decent day nonetheless, up about 1.75%. I wouldn't start kissing each other just yet, but it's certainly an improvement as of late. The rest, even with today's massive rally of over 2.5%, still looks like it's in a lot of trouble. As you can see, pretty serious slide remains in place there. Also has a death cross with the 50 crossing below the 200-day moving average. Let's take a look at the energies. Now, energies are one of the stronger sectors on a relative strength basis when you compare them to the other sectors, that is. But they're still looking toppy in here. You can see we made this little peak just above this prior one with double tops. When they do two things usually. Normally, they rarely just stop right at the prior peak. Normally, they overshoot or they undershoot. In this case, we had a little bit of an overshoot, and that gets everybody excited. Everybody's thinking, oh, here we go again. This thing's going straight up. I better just hop in. And then when the market begins to sell off, they're trapped on the wrong side of the market. So remember, everything I do has a psychological backing to it. Let's take a look at gold, the commodity. Gold, the commodity, the radio guys are finally right for a change, but they were really preaching this thing as it went down for weeks and weeks and weeks and months. But you can see pretty good trend as of late, but I wouldn't rush out and buy it because you've got a little overhead supply. And I'd like to see some longer term follow through just for S&Gs. Let's see how far this thing goes back. Let's see if we get a monthly. So yeah, this monthly chart actually makes it look better than it is, but let's just see something here. Let's see if we did. Is that right? Let's go back one. But you can see, just eyeballing this is like a 50% haircut from here to here. So gold, like any other market, doesn't always go up longer term, although over that period of time for the GLD ETF, it looks better than I thought it would. If you take a look at like spot gold going back years, you'll see that there's periods where it'll go a decade without making new highs. Anyway, let's take a look at a couple other areas. You can pretty much throw a dart. Let's get back to let's see if we can get back to just a moving average. There's durables. You can see lots of Landry Light below that 30 EMA. In fact, let's just do this real quick. Let's get a window over here. So what I'm going to do is I'm going to go to ACP real quick, and then there we go. So I was talking about the Qs earlier, and the Qs look a lot better again than everything else. So this just by accident is Landry Light, and you can see it's green when the lows are greater than the moving average. And as a general statement, you want to be long as you have green. And then I actually have a pattern called Landry Light pullbacks, where you're looking to play pullbacks to the moving average after about 20 bars of Landry Light. But if we shift gears and go to a weekly real quick, you could see that obviously this was a really nice period to be in the market, sans the pandemic slide. So you had about 75 weeks, round numbers, where the lows were greater than the moving average. And then obviously we had the slide coming into 2022. We had a nice rally over the summer, and now we're back to zero for the Landry Light. As soon as the price touches the moving average, the count goes back to zero. Remember, this is count and not magnitude. So let me show you I don't know if I could share these templates. If somebody knows if I can, I'd be happy to share them with you. But let's take a look at the zones. Thanks to Jeff, I now use these zone charts. So if you look at the NASDAQ, remember the buy is 2 bars of Landry Light. So we are on a weekly chart, okay? That's a weekly chart. 2 bars of Landry Light above the 50 simple. We have that here, 1, 2. So it was a buy on that close. And you can see right around that 320 level I talked about earlier. And I was underwater for about 3 weeks or so, and then finally it took off. And then I didn't realize we were up here around 380. So that's 60 points, 60 something points. And that's a little hard to watch evaporate, but I'm going to try to hang on a mechanical basis. Everything I do is discretionary. And one thing I didn't build into this system was money management and stops and things like that. Basically, you get in or you get out, and it's more of a get you out of the way type of system, but it does have a buy to get you back in. And that, again, is 2 bars of Landry Light plus a close within 10% of the 50-week closing high, okay? So Q is looking pretty good, and they haven't triggered. In order to trigger a sell signal, they would have to come down here below 329. And believe me, I don't want to ride down a 60-point gain to gain only 10 points. But let's see if I can hang on to this as long as I can. So that's that. Let's just take a look at the spiders real quick. And you can see a nice little bounce back. Now, somebody was asking about spiders versus the S&P 500. So the S&P, the cash, triggered a sell signal, but the spiders didn't. And this might have something to do with the rolling chart. So I need to check this tomorrow and see what that chart looks like to see if it did close properly. But if you take a look, let's see what cash is doing real quick. And then if there's any individual stocks you want to look at, yeah, see, cash did trigger a sell signal, whereas the spiders didn't. So two different ways of looking at things. All the research was done on cash, so that's why I use cash for this particular indicator. Let me just show you something really quick. Let's do like a longer term Landry Light, and then let's change it to a 50-week moving average. Let's just do a weekly with the 30 EMA. The 50 is going to be a little slower. You'll catch some longer trends over time, less whipsaw, but you'll also have bigger drawdowns. But you can see lots of green when that lows are greater than the moving average, obviously. And then it did take a little while to catch up on the downside. It took to this bar here before you had the first downside bar. So make sure you're looking at other indicators. And then for the record, the TFM 10% system did trigger on this big down day here, trigger to get out of the way. But as you can see, just following the Landry Light and just back to chart way out, okay? Green, Tarzan speak, good, okay? Look at the red starts piling up, that's bad, that's a bear market. Lots of green in between, right? And then red again, bear market. It looks pretty simple when you look at it like that, doesn't it? It always get excited when I'm presenting, when I see it's like, well, Dave, just continue to keep things simple because that looks like it works pretty good. All right, let's get back to stocks or the rest of stocks. We'll take a look at some sector action and then we'll open it up for your individual questions. Foods had a pretty good day today. So far, they remain in a downtrend, though. In fact, one thing you might want to watch tomorrow in the spiders, especially in a lot of sectors, is if we get an opening gap reversal or ogre, as we call them. Let's say the market gaps higher tomorrow, but then starts coming back in. So that downtrend is behind you. People might use that relief rally, so to speak, as a chance to get out, and you might be able to short into that. So keep an eye on your ETFs tomorrow. Let's take a look at, like, for instance, SPX. We might get a big gap down tomorrow, but then it might be followed by a reversal. So if you're an aggressive trader, it might be a good way to play an intraday reversal. Nothing's guaranteed, though, obviously, so make sure you wait for some sort of follow through. As you go through the sector after sector after sector, looking pretty ugly. Had one good day so far, but certainly not enough to get excited about. Drugs have absolutely imploded in here. Remember earlier I was saying that sometimes a double top overshoots and fakes everybody out. Then other times it stops short and people buy in here thinking that it's going to go to here, and then it rolls back over and spits them out. So that's another thing to look at. Everything I do from a technical analysis standpoint is performance based. Okay, I'm looking at moving averages. I'm basically looking at price first and foremost before I add any indicator whatsoever. Even indicators I'm proud of, like Bowtie Proper Order and Landry Light and all this other good stuff, does not indicate anything. It shows you what was already in the charts. Just say no to drugs. Yes, unless you want to short them. Or as my mom used to say, just say no, thank you. I stole that from some comedian. I forget who it was. Anyway, take a look at, like, health services, and there's your persistent downtrend. It tends to go down day after day after day after day. A little bit of a rally today, but certainly nothing to get excited about. Linda Rasky once said, if you don't know where a market's headed, to ask a 6-year-old kid, because he's not invested, obviously, and he doesn't care. You almost need that childlike mentality when it comes to markets. Is it going up? Is it going down, or sideways? But whatever's going on in your life and whatever's going on in your portfolio is going to influence you. And that's something I've been talking a lot about lately, is extraneous influences. But a 6-year-old kid doesn't have those extraneous influences. And in fact, it's kind of interesting that I quoted that so many times that I had to quit quoting it because people were giving me credit instead of Linda, but Linda did come up with that. Manufacturing, just throw a dart. Most of these areas, M&C had the mother of all rallies today. I wouldn't rush out and buy it just yet, though. These are the home builders. Tomorrow, we could have the mother of all opening gap reversals. Their transports, doesn't take a rocket surgeon to see that they're in a pretty serious downtrend. So far, just pulling back a little bit. Software, push it back into this range. So that's one of the better looking sectors. I wouldn't rush out and buy it, though, unless it could break out the top of its range. Semiconductors, one of my favorite areas to watch. Semiconductors could really help confirm what's happening in the overall market, especially if it's going up. The market's going up and semis are going up. That is a good thing. Somebody once said, well, it's like since the digital age, the semiconductors are kind of like the electronic superhighway. But it's also kind of interesting that because of Amazon and online, the trucks and trucking are still moving quite a bit. So transportation in and of itself is still an important area, obviously, of the economy. So that we haven't gone completely digital. Like a friend of mine works in he works for an international paper, and he's like, I'm like, paper? Who uses paper? He goes, You got any Amazon boxes on your front porch? I see you got a couple right there. It's like, he sounds like a Ross Perot that lived in Mississippi because we make those boxes. So okay, all right, I got you. Uranium, one of the areas that has been doing pretty good as of late. Uranium could be really, really choppy and kind of hard to hold on to, but so far uranium, one of the few areas doing okay out there. I'm actually seeing shorts setting up. We actually have a short tonight in coal. So the energies in general aren't doing so hot, except for uranium seems to be doing okay. All right. Anybody want to talk about stocks? Any individual stocks you want me to look at? I know on Facebook we talk a lot about stocks during the day, but if there's anything that you guys want me to take a look at, I'll be happy to do. Happy to look at it, give you my 2 cents. Just FYI, we're long LFMD in the portfolio. You can see back here, this was a Landry Light pullback, and here's one where it just kind of died out for a while, and I did a few dead money reports on this, and I told everybody to hang tight and just follow the plan. The stop was fortunately down below this base, not on purpose because I didn't know it was going to make this base, but it was far enough away to help avoid being stopped out of noise alone. And thank goodness it did hit the IPT, and we're almost closing in on multi-year highs, and certainly closing in on new highs since we've gotten into this one. And the only other stock we have now, we got stopped out of MHO today. The only one we have left, that was a short, is KNF. And KNF, believe it or not, right at these all-time highs, knock on wood. I never dreamed I'd have two longs defy gravity throughout all this mess, but knock on wood, again, so far so good. All right. Any questions? Anything unanswered? Anything I could flesh out a little? Any individual stocks? Okay, I got a quiet bunch tonight. Well, obviously, I want to thank everybody for attending tonight. Thanks for your patience in getting this live stream up and running. Let's hope, it's something we should never do in trading, but let's hope that it continues to work. To everyone here that's in GoToWebinar and Facebook, I'll see all you guys tomorrow. To everybody in YouTube, have a good weekend, and I'll see you next week. Thank you so much. And may the trend be with you. You're welcome.